there's clearly plenty of workarounds that Russia can use, not the least of which is bilateral trade using gold, or respective currencies. It sounds like Russia and China now are conducting all of their trade in rubles and yuan.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And with us today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Hey Elijah, a long time no talk to, and thanks for having me on. I appreciate the invite.
Definitely. It's great to have you. And I wanted to have you on. You recently wrote an article about how Russian sanctions are going to impact the petrodollar and really the status the dollar has as a world reserve currency. So can you expand on this?
Sure. I mean, it's not my original thinking. I maybe kind of put my own take on the matter, but as we've seen, the U.S. has they've basically frozen Russian, and asked Western European countries and allies to freeze Russia's reserves being held at foreign, for Russia, foreign central banks. So like at the Fed, Bank of England, European Central Bank, et cetera. And so what that would mean is that the currency reserves that Russia keeps at those central banks for trade purposes can't be used. And it's in a sense, it's kind of a weaponization of the U.S. dollar as the reserve currency, and it's basically, I mean, we obviously know what the reason for it is this time around, but it's basically a country, the country that has the world's reserve currency saying, hey, if you don't behave and conduct yourself the way we think you should, then we can make it very hard for you to conduct trade in the global theater. So what I think the unintended consequence of that, because first of all, there's clearly plenty of workarounds that Russia can use, not the least of which is bilateral trade using gold, or respective currencies. It sounds like Russia and China now are conducting all of their trade in rubles and yuan. So and China did not freeze Russia's currency reserves at their central bank, the People's Bank of China. And so, I mean, if I'm a country, especially one that's trying to be, more neutral in terms of, global geopolitics, I'm looking at that and saying, well, what's to stop the U.S.? What if they get like an uber green promotion president in the next election cycle, and this president doesn't like, the amount of carbon that my country's putting into the atmosphere? What's to stop them from freezing our dollar reserves at the Fed so that we can't use them? You see what I'm saying? And so what I think it's going to do is I think it's going to force a lot of countries to evaluate the extent to which they settle their trades, with non-U.S. countries in dollars. And it's also going to force them to look at where they actually keep their currency reserves. I mean, in the electronic world, there's no reason that, let's just use Russia as an example. There's no reason that they would have to keep dollar reserves at the Fed. I mean, I think they do it just out of convenience. So, and I think it's going to make a lot of countries just say, hey, we got to evaluate our currency reserves as is anyway. Do we want to hold as much as we hold in dollars? I mean, the Feds over there, they've devalued the crap out of their dollar over the last 2 years with all the money they've printed. It's causing price inflation in in dollar-based transactions. And I think it's also going to. I think a lot of central banks are going to start looking at keeping some of their central bank reserves, or a lot more of their central bank reserves, in hard assets like commodities and gold, and possibly even silver. Maybe start accumulate silver again.
Now, what kind of an advantage does the dollar being the world reserve currency give to the U.S.? Because it seems to me if other countries are holding dollars and trading in dollars, this creates a huge demand for U.S. dollars. But if that's going to be taken away, we could see even higher inflation. We could see dollars moving back to the U.S. and we'd just be seeing higher inflation than we already are today. Your perspective on this?
Well, having control of and ownership of the world reserve currency basically gives the U.S. all of its power. And they back up that, there's nothing behind the dollar. It's not backed by gold. It's backed by the military power of the U.S. And that's in decline. I know a lot of people don't want to hear that, but that's a fact. And to me, that's part of the reason why some of these Eastern Hemisphere countries have said, hey, first of all, our economies, especially with China, our economy is contributing a lot more to the global GDP than it was 30 years ago. And yet, a very small percentage of global trade is conducted in yuan, the Chinese currency. And so having the reserve currency is what gives the U.S. its power. And it's being reduced anyway. It's been systematically reduced. It used to be like 95% of all trade was conducted in dollars and settled in dollars. And now it's something, I haven't seen the most recent numbers, but it's something like 65%. So it's on the decline anyway. And it basically, as we're seeing now at the extreme, it holds countries captive to U.S. policy desires and wishes, and the imposition of U.S. morals and values on the rest of the world. And maybe that doesn't bother the Western Hemisphere countries as much, or the Western Hemisphere northern countries as much, but it certainly, I think it probably irritates a large part of the Eastern Hemisphere world, and that's where the majority of the world population is. So, a real crude reading of history is that when you start to see a world power lose its, devalue its currency and lose its ability to control everyone else economically, that's usually where wars start. And that may be, I think that's part of what we're seeing going on over in Ukraine, because let's face it, that situation is really a de facto battle being fought between NATO and Russia, and really the US and Russia.
It seems interesting, if we step back for a second, that the U.S. imposing sanctions is going to be impacting negatively the U.S., right? So why do you think these sanctions are in place anyways?
I think part of it is a political stunt. Like, hey, American public, we know you disagree with what Russia's doing, and we disagree with it. So we're gonna try and hogtie Russia economically. And as it turns out, as you point out, Russia, if it wants to, in retaliation, could just cut off the sale of energy to Western Europe. And actually, we import quite a bit of Russian oil. So I haven't read that the U.S. has actually blocked Russia from exporting oil to the U.S. And we know it certainly hasn't in Europe. So as you point out, I think the sanctions that it takes two to tango, and two can play that game. And Russia produces key commodities that the rest of the world needs. And so if Russia could sell them all to China. I think I just read this morning that maybe it was in February or something, China bought all of Russia's liquid natural gas. So, Russia's got a ready market in China that's 3 times the size of the U.S. market, and it's larger than the U.S. and the EU market combined population wise. So again, I think the sanctions are as much as anything politically motivated, so that Biden can get up in front of the public and say, see what I'm doing, as he reads that off the teleprompter.
Now, the impact this is all having on the average American, the whole Russia-Ukraine situation, at least it seems like, I mean, the reaction to it in the markets has definitely impacted people's wallets when they go to the pump, the price of gas being super high. How do you see the public and how do you see inflation from here continuing? Do you see that this increase in oil prices, for example, was kind of a short-term reaction to Russia invading Ukraine, or do you see inflation continuing for the foreseeable future?
Oh, I've always said that I think inflation is going to get much worse. We already know that there's a lot more inflation at the producer and wholesale level that'll show up at the end user or the consumer level, the retail level, 3 or 4 months down the road when you look at the PPI number versus CPI, et cetera. So for instance, when you see the PPI number, and it says it's up 8 or 9% or whatever it was year over year, and I think it was maybe 10% month to month on an annualized basis, that's price inflation that's going to show up down, in the next 2 or 3 months at the grocery store, et cetera. So, and everyone's focused on the cost of energy right now, but Russia and Ukraine, I think combined are like the combined, it's the largest supplier of wheat to the world or something like that. It's a significant supplier of grain-based commodities, especially wheat, to the rest of the world. So, and from what I've read, they need to get the wheat planted like within the next few weeks over there, or there's not going to be any wheat to harvest to ship to the rest of the world. So it's going to be interesting to see how that situation plays out. But this is an exogenous event that's going to affect price inflation, and I don't know how long it'll affect price inflation for. It may be over the long term non-recurring, but we're just now seeing, in my opinion, a portion of the price inflation that occurs from fiat currency devaluation has emerged, say, in the last 6 to 9 months. And the Fed's been printing, they dumped another $3 trillion into the system all at once in early, in the spring of 2020. And then they've been printing up until recently roughly 120 billion a month and dumping it into the system. So financial system. And so, we still that's still, it's dollar devaluation that's been ongoing over the last 2 years. And it's just now starting to show up as price inflation. I think it's going to get a lot worse. And then obviously this exogenous event that could affect supplies, that turbocharges it. So yeah, I think people should expect much higher price inflation. And I suspect that realization is why the price of gold has shot up quite a bit this week, especially in the last 2 days.
You focus a lot on mining stocks and precious metals. How do you see this all impacting gold and silver? Because obviously, if this is going to be negative for the dollar, this will probably be positive for the precious metals.
I think gold and silver are artificially held down anyway. I think they're artificially undervalued relative to the reservoir of fiat currencies that have been created over the last 10 or 15 or even 20 years. And that doesn't include, that it's not just the dollar, it's the yen. I mean, Japan's been printing their yen like crazy for the last, 30, 35, 40 years. It includes the euro. Even the Chinese have been, copious printers of their currency. And so I don't think what you're watching out here is necessarily So let's say the price of gold today is up $30 or $25 from 1938 to 1963. I'm looking at the April futures contract, which is close enough. That's not, to me, that's not so much the price of gold going higher. It's reflecting the value of the dollars that are being used to pay for that gold going down in value. Does that make sense?
I think it does. And that's one of the main reasons for investing in precious metals is to preserve your wealth. What we're seeing right now is incredible volatility in the precious metal markets as this Ukraine-Russia situation has unfolded. Do you see increased volatility going forward?
In the precious metals? Yeah, I think it's going to be increased volatility. It'll be two-way volatility, but it's going to be skewed to the upside. And especially if as I suspect, a lot of countries are going to start, their central banks are going to start accumulating a lot more physical gold and make sure that the gold is delivered to the country's central bank, patriated or repatriated back to the home country, because, why would you, if Russia is keeping some gold at the New York Fed, and I don't know if it is or not, but, what's to stop the Fed from saying, oh, hey, no, you can't use this gold. And by the way, we're not going to give it back to you right now. You see what I'm saying? Especially with precious metals. I mean, it's the same thing with currency reserves as we're seeing, but with precious metals, possession is 100% of the law.
No, one way to take advantage of the price of precious metals increasing is obviously holding the physical metal. Another way to take advantage of that you focus a lot on in your mining stock journal is mining stocks. So can you share an update on where mining stocks are right now and where you see them heading in the near future?
That's a really good question because, mining companies, along with every other type of company, has faced, they've seen their cost structure rise quite a bit over the last year because of inflation, and so whereas we were starting, with gold sort of averaging, in the 1800 area for the last, I don't know what, 18 months or whatever, the companies have been turning in great revenues, but it hasn't, their margins are starting to get hurt by price inflation. And ultimately, I think what's going to happen is the price of gold and silver are going to have to move up a lot more in order to compensate these companies for their increased costs. So, but we might have a window here where you could see some earnings that might disappoint. But, again, that's looking in the rear view mirror. I mean, companies that, now it's like, I think for the month I think for the first quarter, I think I have to look at this, but, for the first quarter, the price of gold has spent a fair amount of time above 1800. So, and that'll translate into much higher revenues. So, I guess the net I would say is that, in relation to where the price of gold and silver are now, and in spite of the fact that producing mining companies have a higher cost structure because of inflation, the mining stocks, in my opinion, are the cheapest segment of the stock market. It's the mining stock segment is the cheapest type of stock on the New York Stock Exchange right now.
So it seems like there could be some issues in the near term with regard to the cost structure because of inflation, but longer term, are you still very bullish on the mining sector?
I'm very bullish. I mean, I think we're going to start to see much higher prices for gold and silver. I don't necessarily have a time frame in mind. There's plenty of other people out there people who are watching this, they can surf around the internet and see what some, the time frame people put on there. I've kind of learned not to put a time frame on gold and silver, just because of the degree to which it's manipulated over the short term. But Yeah, we're going to see much higher prices for gold and silver, and that's going to translate into much higher prices for the mining stocks. And really, the probably the most undervalued segment of the mining stock universe is the junior exploration stocks. Some of these stocks haven't even really moved since I guess you could say last fall. Say October is kind of when the rally started in the sector. And a lot, like I said, a lot of these junior exploration, micro cap, I call them venture capital juniors. A lot of those haven't really moved that much in price. And I think on the assumption that we've got a longer term sustainable move upward in gold and silver, and that means that the large cap mining stocks and the producing mining stocks, the mid caps and the smaller caps, are going to start to move higher. At some point, capital will start to chase the junior development companies, because those are the companies that are developing resources in the ground, and we're going to start to see a lot more acquisitions. So I focus on that area of the mining stocks, although I do cover some producing mining stocks, because that's, to me, the greatest amount of alpha can be found in the junior venture capital stocks.
All right. Well, David Kranzler, we really appreciate your time today. Before we let you go, do you have any last thoughts for our viewers, and where can our viewers find you online?
I mean, to me, the most important thought is, and I've been getting this question a lot lately from my subscribers, is what percentage of their investment portfolio should they have in physical gold and silver? And I mean, I think you need to have at least 10%. It's up to everyone's. To me, you make your own mileage on what you think is going to happen down the road, and what type of investment you think is your portfolio will benefit the most from. And I tell people who I think really understand what's going on and understand the role that gold and silver play, you should have up to 50% in physical gold and silver. And I don't sell physical gold and silver, so I don't have equity interest in promoting the idea of people running out to buying it. What people do with their money is their own business. However, I will urge people not to use GLD or SLV or the various metal ETFs. You're not really owning gold, and when you sell it, you get more fiat currency in your account. You need to hold and possess your precious metals, your gold and silver. And I can guarantee you, everyone listening to this can find places in their house where they can hide their gold and silver on the extremely rare occurrence that they might get broken into, that whoever breaks into their house will not be able to find it. So that would kind of be my parting thought. And, I think, if you see the world the way I do, and things economically are going to get a lot more difficult and inflation is going to get a lot more worse, that means we're going to see much higher gold and silver prices, and also much higher mining stock prices. But, the key to this sector is being patient. You play the long game when you invest in precious metals.
All right. And your website is investmentresearchdynamics.com?
Yes, that's correct. And there's 2 links at the top where you can get more information on my newsletters.
Fantastic. Dave, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.